Welcome to the Freedom First Retirement Podcast, where we strive to simplify your financial life and provide you freedom from taxes, risk, stress, and poor advice. And now, here are your hosts, Darren McComas and Sean Peel.
Hey everyone, my name is Darren McComas. Welcome to the Freedom First Retirement Podcast. This is episode number 7. Today's date is December 15th, 2022. Again, thank you so much for joining us. My brother-in-law, Sean Peel, could not be here today, so you're stuck with just me, but we have some major topics we wanted to go over with you before we get into the busy holiday season here. So couple major events that we're going to cover today. CPI was just released yesterday. We're going to talk about interest rates and what's that doing to our budgets. The gates are going up in a lot of these different exchanges as well as different REITs. So we're going to talk about that and how that is going to play out. And then we're going to go through the markets and what we see going on. So first topic today is, and if you're joining us just audio only, I'll kind of walk you through this chart. For those watching on YouTube, obviously we'll go through this chart, but this is a chart of CPI throughout 2022. And kind of entered January around 7.5, and it's grown. It kind of peaked out this summer in June around 9.1%. Then inflation's kind of rolled over and we've gradually started to come down. Just the other day, it was announced we were at 7.1, a little lighter than expected. The street was expecting a 7.3. Now, this is good news for the average consumer. This means that, prices are coming down. Energy is coming down. We've seen the price of gasoline drop recently. So those are all good things for the average American. However, we are a long ways away from that target 2% that the Fed has set. Yesterday, Jerome Powell here, our good buddy Jerome Powell from the Fed, raised rates by 50 basis points, kind of exactly what the market was expecting. But he was also very hawkish in his speech. And he said, word for word, changing the inflation target is not something we're thinking about. And it's not something we're going to thinking about under any circumstances. So our inflation target is 2%. Again, we're at 7.1, long ways to go. And the Fed knows they cannot mess this up. They cannot, cut rates too early, turn dovish too early, or inflation would rear its ugly head again. And then they would have to even be more aggressive to get it under control down the road. So I think Jerome Powell is playing the Volcker playbook from the early 80s, and he's going to just continue to keep raising rates and then keeping rates elevated when they do hit the pause button. But I really agree with what he's doing, and that we're not going to be cutting rates at all in 2023. And the markets really reacted negatively. You can just see when CPI came out earlier this week, the markets rallied and they saw that, inflation coming down is a good thing. Let's rally. The markets went, higher immediately, thinking that Powell's going to turn dovish based on that lighter CPI number. And he did not deliver as they hoped. He remained hawkish, kind of what we thought he would do. And the markets immediately did a 180. A couple of things we also wanted to highlight besides inflation. We see, a recession is looming. If we're not already in one, we expect that we're going to enter one in 2023. And one of the telltale signs that back tests very well historically is the yield curve inversion. This morning, the 10-year versus the 3-month was at a negative 90 basis points. Again, this 3-month to 10-year back tests very well. It has about a 98 to 99% historical accuracy of predicting a recession within 1 to 2 years. So a minus 90 basis points is one of the deepest inversions we've ever seen between a 3-month and a 10-year Treasury bond yield. So does that mean we're going to have a recession? No, but it's very highly likely. Again, high back test very well. And this chart we're showing you right here, there's a lot of information on this chart. We get it, but you can see when the yield curve does invert, Shortly after, there is a recession. Those gray vertical bars that you see, those are periods that are considered recessions. So every time the yield curve inverts and you see the red show up there on the chart, goes under, goes negative, then we have a recession immediately following. Almost every single time. This goes all the way back into the 1960s. So here we are, go on the far side of this chart. We have the yield curve inversion during COVID, and then shortly after, a very short, narrow recession. And then 2022, on the extreme right of that chart, you can see the yield curve is inverted. Again, 90 basis points, pretty deep. Haven't seen that deep of one really since the 1980s. They say typically the deeper that yield curve inverts, the longer it stays inverted, the worse the recession is going to be. Another thing that I think is important for markets to realize too is, as the Fed keeps raising interest rates, that means that the rates, as they go higher, we're going to owe more interest on our national debt. And the Fed knows this, and the Fed realizes that they have to really just smash inflation. The sooner the better, because right now the interest on our national debt is projected at $766 billion. This will make it the number one line item on our budget as a country, outpacing Social Security, outpacing Medicare, outpacing our military. These are completely unsustainable levels. If we do not get inflation under control quickly by hammering interest rates and being tough on inflation and getting it to stay down, then this becomes a real issue. And this is going to cause, maybe some very tough decisions in Washington, D.C. as far as funding goes. Some budget cuts are going to have to take place. Otherwise, Social Security, Medicare, and even our military are going to be in serious jeopardy of having some major cuts. So Jerome Powell knows this is an issue, and this is why we take the stance that he is not going to be cutting anytime soon. He has to get this right, or we're going to be in a world of hurt on multiple fronts. Some other news that I think you need to be aware of, we're starting to see these bubbles pop all over. We've seen crypto pop. That, Bitcoin's down over 70% year to date. But some other issues, the housing market is starting to crumble. And this is starting to bleed over into some things called REITs, real estate investment trusts. And what these REIT companies do, they own, massive amounts of property within these REITs, and then they pay out, monthly or quarterly dividends to their shareholders. Recently, Blackstone, one of the world's largest institutions, they have one of the largest non-publicly traded REITs. It's called BREIT. They just told their investors they're closing the gates, and we are no longer allowing redemptions. And this is something that REIT companies can do from time to time. They did it during COVID. They're starting to do it again. As investors want to take their money out, maybe they want to redeem some of their shares that they invested, get their money out and place it somewhere else because they see what's going on in the real estate market. That means these REIT companies need to go out and probably sell properties that they own, maybe a huge building, a shopping mall, things like that. Well, if there are no buyers because the real estate market is frozen, then they have to put the gates up and say, we cannot honor any redemptions at this time. We just had a client in our office yesterday and was looking at getting out of some of his REITs because he's seen the market price drop dramatically. While those monthly dividends are nice, the drop in the price of the REIT is not so nice. So he wanted to redeem his shares. So we called the REIT company, and sure enough, they're severely limiting their redemptions to 3% per quarter and probably go to 0% sometime next year. So not a huge fan of real estate investment trusts. I think this is a canary in the coal mine when these companies start closing the gates and not allowing investors to take their money out. That is not a good sign for what is coming down the road. And I think it's super important we realize that the real estate market is the biggest market out there. It's bigger than the bond market. It's bigger than the stock market on a global scale, massively bigger than anything else out there, as this chart shows. So as the real estate bubble starts to pop and collapse, then I think this becomes a big problem also for the stock market. Besides REITs closing the gates, some of these crypto exchanges are also closing the gates. We saw FTX recently blow up, and they stopped their redemptions, costing investors billions of dollars. And now you have the world's largest crypto exchange called Binance. They did the same thing just the other day. They closed the gates temporarily, not allowing people to take out their Bitcoin or withdraw US dollars from their accounts. And I just think these are all canaries in the coal mine, that things are getting tougher out there, and that we really are looking at heading into a recession in 2023. So that brings us to our risk management team, which is Hedgeye Risk Management. And I think they have one of the best teams out there. They have shown us that their quad map was just recently updated. And if you look over there in the bottom left corner, fourth quarter 22E, that is what they expect this quarter. Of course, we're getting to the end of it, only a few weeks left here, but pretty deep quad four. They see the economy really slowing down and going negative. That's that vertical axis on that chart. And then really being further to the left, much further to the left than the third quarter. That means inflation coming down. And you saw that in one of the first charts I put up today. So those are all two very bearish signs for the market when they happen together. You have an economy slowing down, the rate of change being pretty rapid, and as well as inflation slowing down or decelerating. That puts you into that lower quad four quadrant, which is generally very bearish. They call it the recession quadrant. So a couple weeks left in the year, a couple weeks left of fourth quarter, and then we go into first quarter and second quarter of next year. And according to this quad map, they expect us to still be in quad four. And further, you're starting to see inflation really second quarter decelerate and maybe turn into disinflation or deflation outright. Again, deep quad four. So we expect really the next 3 to 6 months to be pretty bearish for the markets. There is some good hope there. Third quarter of next year, I know that's a long ways off, but they do have us the economy picking back up, and inflation even coming back to more neutral there, and that would put us in quad one, which is a much more bullish setup. And maybe the Fed by that time has hit the pause button on rate hikes, and we have a much clearer read on the market. So that is some good news that sometime next year we will hopefully come out of this quad four setup that we've been in pretty much the whole 2022, or at least how the markets have been viewing it. And we'll keep you updated if there's any changes from Hedgeye on the quad map. Quick update on markets year to date. Yesterday was a bad day. Today is even worse in the markets. So we have the S&P 500 down almost 19%. So it's knocking on crash territory again. The NASDAQ down 31.5% year to date. So deep crash there in those tech stocks. And the Dow Jones hovering around about 10% drawdown. So we did have a nice bear market rally at the end of October through November. And that rally was really just fed off the narrative that the Fed was going to pivot. And I think Jerome Powell finally stuck a fork in that narrative. And now watch, the new narrative is going to be a recession as we head into 2023. And that, of course, is a pretty negative sentiment out there in the market. So we're going to keep a close eye on this. But I would expect, just like every bear market rally that we've seen in 2022, this one looks like it's coming to an end. And so expect some very choppy markets heading into the beginning of 2023. And if Hedgeye and their projections are right, we may make a new lower low in the markets sometime January, February-ish. And I really do think, if you've ever heard of this, it's called the Santa Claus rally heading into the end of the year. Markets typically have a nice run around Christmas time into the end of the year. And I think Powell officially killed the Santa rally this year with his speech yesterday. But again, we'll keep a close eye on things. And as far as you're concerned, all right, so we're projecting pretty choppy markets ahead, quad four setup. What are we doing as far as your investments? So we've made some changes to our models. with recommendations and guidance from Hedgeye and their data. It's starting to appear more like a typical quad 4 setup. Typically in quad 4, you want to be in precious metals, you want to be in bonds, you want to have safer asset classes like consumer staples, utilities, healthcare. Those all back test and outperform in a quad 4 compared to, say, technology or energy. So we've added precious metals recently, small sizing positions in all of these in gold, platinum, and silver, and those have done pretty well. I think we're starting to see these really perk up and come to life. We've added some bond positions. We've been very anti-bond through 2022 as the Fed has continued to raise rates on the short end. On the long end, the market is saying, now might be the time to wade back in on the 7 to 10 year treasury. So we have a ETF that we like. It's ticker symbol IEF. We've been adding some positions there, as well as a deflationary bond. It's BNDD, and another ticker symbol is SWAN. Both of those, again, are in that fixed income class. So the other, we've added some longs on the consumer staple, utilities, and healthcare, which back test pretty well to outperform in quad 4. We have taken energy off the board. We got rid of AMLP, oil producers, XOP, and just XLE or VD, one that we have used in the past. So energy is out. We see energy maybe on the precipice of crashing. So that is gone from our portfolio model. So again, a more typical quad 4 setup going forward. We think we're positioned to weather the storm and do well with this setup. And today is a good indication. We are flat on the day, even though the markets are down over 2%. Enough about the economy and the markets. I wanted to have some good news here at the end of today's podcast. And really, we are now up and running with an integration, new software to our firm. It's called Pontera. Pontera allows us to actively manage our clients' retirement savings accounts that are held away from TD Ameritrade. So just like we can go in and actively manage and buy and sell and place trades within your accounts at TD Ameritrade, before Pontera, we didn't have the ability to help you out on your 401k or 457 or 403, all those retirement savings accounts that you have if you're still working. But now using the Pontera integration, we can set up a secure link where we can actually go into your retirement savings accounts and actively manage them just like we do our models at TD Ameritrade. So if you're interested in getting some professional help, some professional management within your retirement savings accounts, things that are held away from TD Ameritrade, feel free to reach out to us and see what that looks like. It is billed on a quarterly basis. The billing is set up a little differently than we use through TD Ameritrade. But Pontera's done some studies, and there was a reason they're very up and coming and becoming very popular in the advisory space. And I have this graph here that right off the Pontera website, and there's been several studies that have shown that having professionally managed accounts outperform the self-directed accounts by about 3% annually, and that's net of fees. So, if you still have several years of working and contributing to those retirement savings accounts and want someone who's going to look over that and make sure you're positioned, for the upcoming quad 4 setup, that you're in the right kind of allocation so you don't lose a nice growth that you've got maybe in the last 6 to 8 weeks, then, I think Pontera is a good fit. And reach out to us and let us know that you would be interested, and we can go into more detail about this. But I am excited that we're going to be able to help clients with their assets held away from TD Ameritrade as well. And we are heading into, only 10 days left till Christmas. And I know I still have some shopping to do and some presents to wrap, and it's getting into that very crazy holiday season. So just wanted to wish you a very Merry Christmas from everyone here at Abraham and Company. Be safe, enjoy the time with friends and family, and just remember what this holiday season is all about. We appreciate you so much, and we thank you for trusting us, and we look forward to serving you again in 2023. So again, Darren McComas here, signing off for 2022, and expect our next podcast episode to be right there at the beginning of January, and we're excited for what next year has to offer. So thank you so much. Merry Christmas to you and all your family. Thank you.
Thank you for listening to the Freedom First Retirement Podcast. Make sure you subscribe so you don't miss any future episodes. For more resources, or if you have any specific financial questions, contact us at abrahamco.com. That's abrahamco.com. The Freedom First Retirement Podcast and related materials are provided for general information and entertainment purposes only and do not constitute accounting, investing, legal, tax, or professional advice. Visitors should not act upon the content or information found here without first seeking appropriate advice from an accountant, financial advisor, lawyer, or other qualified professional. Thank you for listening to the Freedom First Retirement Podcast. Make sure you subscribe so you don't miss any future episodes. For more resources, or if you have any specific financial questions, contact us at abrahamco.com. That's abrahamco.com. The Freedom First Retirement Podcast and related materials are provided for general information and entertainment purposes only and do not constitute accounting, investing, legal, tax, or professional advice. Visitors should not act upon the content or information found here without first seeking appropriate advice from an accountant, financial advisor, lawyer, or other qualified professional.